This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the podcast, I have Bill Adams. Bill is with a hedge fund for a long time. He is a private trader. He's a system developer. That means the logic and the code. He's based in Zurich. No retail clients right now, just large institutional clients. This is part 2 of our conversation. I hope you enjoy. So we exchanged some notes. We talked about some things since your first podcast. And what I want to clarify from the very beginning is going through your notes, and I'm seeing broad diversification. I'm seeing quantitative futures program. I'm seeing price-based. I'm seeing ATR measures, discussions of volatility. But I don't really see the phrase trend following. Is that how you view yourself?
I view myself as a trend follower, but I realize that I'm not a trend follower, let's say, like in the purest sense. But all the fundamentals of trend following are integral to my process.
Let me take a step back. I think personally, look, I've used this phrase for a long time. I wrote a book with the phrase, but you could easily make an argument that it's not the best descriptor of the broad strategy that I just described. Fair enough?
Fair enough. Yeah.
So let me jump in with a big picture thought. So you've been doing this for a long time. You develop the logic of trading systems. You code trading systems. You work for your own account. You have outside clients. For many people out there, and even high-level managers or fund managers, the word futures can be problematic. It can raise red flags. And I know you've had some experience. We talked about our first podcast coming through Chicago. But talk about the idea of broad diversification, because really central to what you do, even when we'll get into the discussion of the risk management and the investment process. But ultimately, it's this broad diversification where you have a trading strategy that allows you to trade crude oil, as you might trade silver, as you might trade soybean meal. Now, of course, you might have different parameter sets and different measures of risk, but the broad overall strategy for these markets is the same. Fair?
Correct. Yep. Exactly.
So try and let the person out there, whether they're, an attorney who's trying to figure out what to do better with their portfolio, you told me that you've been working on a book. So, get into the practical aspect to where you can make the case that you have a strategy that allows an investor, a fund manager, a trader to trade all of these disparate markets with a common system. Just start from the beginning if you can. I mean, it's tough, isn't it, to explain?
Yeah, I mean, it's the hardest thing. I think when you probably come through the business the way we did, or the way I did specifically, is you come through managing other people's money. And the biggest challenge that you have is basically always making sure that you have enough powder dry, for when that opportunity comes along. But the main challenge is, especially if let's say you have something that's heavily oriented towards trend following, is you're going to realize more losses, more losing trades. Although percentage-wise you may not lose so much, but you're going to realize more losing trades, or you're going to realize, periods of time when you really don't make progress from a performance perspective, and so that sort of weighs on you. And so what carries you through that, or what carries me through that, primarily is diversification. And so diversification means that we're looking for we're considering a number of variables that are really not correlated. Because since we have a tendency to sort of trade what we know or trade what we like,
Hold on, but when you say variable, you're talking about the market itself, whether it's crude.
The market.
Yeah, right, okay.
Right. We tend to trade what we like or what we know, and that's really great. The issue is there comes a point in time when these markets don't move in a manner that you're familiar with, and then you can be lost. So moving into a systematic approach allows you just to be more efficient and look at more markets. We kind of reviewed that the last time, but so diversification for me happens on a number of different tiers. And so we talk about, I guess I term it strategic diversification. And so that just lets me gain a better view on the market, but it's not a fixed diversification, meaning that individual weightings are set on a fixed variable, like it's nominal, it's percentage, something like this.
And you mean by that, so if you have a 100% portfolio, you're not saying 10% is going to be affixed to, beans or wheat or corn. You're taking this more from a dynamic risk-based diversification.
Correct. And then, so basically when we talk about risk-based diversification, the individual weightings are based on a contribution, right, of a market to the total risk of that portfolio, right? And so what I'm able to do is I'm able to gain a view on that risk. And it helps me manage the portfolio better. And also, I have, various levels of risk that I'm willing to take based on what I see, but I also have fixed parameters. So I'm never overexposed. The negative part of that is that if I really catch a mover, then, I limit my exposure to that market. Mm-hmm. So in that regard, I'm capped a bit, but
you're comfortable with that because that's taking away some of your downside from your perspective.
Correct. And basically making sure that you're in the game is the most important, right? Because if you don't have the opportunity to trade, then you have no chance to make any return.
Take a step back, though, on the diversification part, for example. And I just want to get really basic because, you might think I'm being getting down at too basic of level, but I think there's some very bright, very wealthy people in this world that if you tried to say to him, let's say you got on the elevator, right? And you're standing next to some guy who he is a CEO of some firm. Maybe he doesn't know much about trading, but he's got the typical, index buy mutual fund. And he's got millions of dollars into these things. And he says to you, hey, what do you do? I'm a trader. I'm a system developer. And he's like, oh, really? What do you trade? You're like, oh, I could trade crude, or I could trade NASDAQ, or I could trade soybean meal, or I could trade the S&P, or I could trade bonds, or I could trade corn. Are you an expert in all those? How do you do that? I mean, don't you get that question still?
I would say I'm not an expert in any of it, but what I will say is that if the markets have every business is seasonal, right? And so that doesn't necessarily correlate to a seasonal result from a trading perspective, but every business is seasonal. So let's just talk about farming since we brought up beans and corn and, we're going into summer. We're at a point in time in the year where the farmers are just deciding what they want to plant, but nothing's been planted yet, more or less, right? So is it corn, wheat, soybeans? We have no idea what they're going to put in the ground. We don't know what the weather's going to bring to us and what the yield's going to be, although now we can start to speculate on that. And so what's driving these decisions primarily is supply and demand, or the interest in that product. So right now, and some of the grains, and I've been reading a ton about grains lately just to stay up on it, the demand is coming still from China because they have tons of livestock. So there's quite a few people that think that these markets are gonna rally. And without becoming too specific about this, there's still a seasonal nature to this market because, Australia, grows a lot of wheat, and South America grows a lot of, corn and soybean now. Right. So we're not sort of on this linear plane. Everything is more or less, based on supply and demand. But how do we address, that from a trading perspective?
I was going to say, but hold on, you're not using the information you just described to me. You just started to make a fundamental perspective.
Exactly.
And you're a quantitative trader, so that information might good for you from the standpoint of cocktail banter at the local party, but that's not what you're using to make your trading decisions.
That's correct, right? But the reality is that, as a quantitative trader, like, what am I measuring, right? So in addition to like looking at price, as I prioritize, some of my signals, some of these things that I want to start to pay attention to are the commitments of traders. And some of the things that, these people may start believing, out of their own need or just any sort of desire that they may have. I can quantify that as well. So I'm basically generating metrics, right? And some metrics I rely on more strongly than others, and some are less common than others, but these are things that we can measure. So from a fundamental perspective, I can say, this and this could happen, over a dinner conversation, but I wouldn't trade on it. But sometimes the fundamentals, when you can quantify them, tend to line up, with, some of the technical measures that I use as well. And then that basically, gives me a signal that I may not see very often, because I have a technical precedent, and then I have huge emotional conviction behind that.
Okay, but you're a 90% quantitative guy, and I'm assuming that
Correct.
means your primary measure of market action is the price itself.
Right, and that's 1,000% correct. And I'm taking this little aside because we're talking about the seasonality, right, of a market.
And I just want to make sure though that people don't get off this conversation and they say, well, hold on, is Bill, where direction is Bill coming from? I just want to make sure I clarify it too.
I don't want to sound like I'm going off the reservation here fundamentally, but basically you can divine different trading opportunities throughout a market cycle, right? So the way some people identify these cycles is they rely on, what they've relied on for years, their experience in the seasons. And they say, okay, well, there's nothing planted here, and I know that this guy's going to order a ton of grain from me later. And if I have a big supply, I'm going to, if I have a big supply and he doesn't have a great demand, I'm going to have to charge him a lower price. And so they have this discussion. What I'm doing is I'm measuring things a little bit differently. I'm looking at price. I really don't watch the news or care about, what people say. But I do pay attention to where the open interest and some of these markets lie, and also which side of the trade that they want to be on. So in that sense, I'm entirely technical. I'm entirely reactive. So I fall more on that quantitative side. Price leads me, and then basically volatility helps me, choose where I want to be in that market at any one point in time.
Okay, so if I get back to the elevator though, and I'm on that elevator and I'm asking you that question, how do you have the expertise to trade those markets? Ultimately, you're saying to that person, I don't have the expertise. I am trading those markets because I'm a quantitative trader who's using the price of each market to make my decisions. 90% Correct. Of your decisions are based on that.
Yeah, 90%. And it's almost purely price, right? And I say 90% because there's these situations that just sort of defy logic and don't make any sense. And at that point, I would just be risk off, because now I'm in an environment where I have completely no understanding of what's happening or why it's happening, and I need more data.
Could I say an example that could be like another October of 2008, where you all of a sudden start to think the ATMs are not going to work again?
Sure, something like this.
Yeah.
Right.
Yeah.
Perfect example. So it's when you don't know what's going on, and because once you become a quantitative trader, a systematic trader, it's incumbent upon you to inform your system of various events. That's how the system makes decisions, right? And the reality is the system can make decisions more consistently than you can in every situation, because it's not going to be influenced by any of that sort of fundamental banter, or there's no headlines. So there are circumstances that you haven't prepared the system to address, and you, as the creator of that system or the person that works with it, have to be aware of what the limitations of the system, what those limitations are, and then you can, make appropriate adjustments.
Have you ever thought about your strategy almost in the context of of evolution, of the tree branch of life, so to speak, and some of the branches die off and the species keeps going. Because the reality is your trading strategy, each year, you don't know where your profits are going to come from.
No clue. And I look at this, I go back now 12 years. And so I'm looking at where it comes from. This year is heavy grains. Last year, grains probably only made up of, I want to say like maybe 15% of what I did. Now it's the vast majority. There's a ton of interest there in that market right now. So it's hard to predict, and I don't need to predict it. I mean, that's the whole point, right? The more data you can take in and the more markets you can sort of evaluate, you always have opportunity, which kind of leads us back to what we were talking about before, which is diversification. I'd rather make a few points amongst 30 markets than to make 100% of my return from one market.
But that could happen with your strategy, though.
That could happen, but it's not the intention, because I know that one market isn't going to consistently deliver me a return year in and year out. You know, right. It may work 9 years out of 10, but that 10th year may be the one that wipes me out. So if I'm appropriately diversified amongst as many markets as is reasonable for me to trade, then what happens is I'm able to sort of flatten out that downside considerably, because I'm not relying on that one market to deliver my returns. And so you basically, from a trading perspective, you become a lot more relaxed because you're not relying on that. Yeah.
So, for example, we were talking about, you were pointing out, I'm not fixed diversification, I'm risk-based diversification. So, for example, let's say a reversal quant trader who has a fixed portfolio of 25 markets, he's long or short those markets at all times, that fixed basket. And what you're saying is you know, even though I know some people have been very successful with that, you're saying I'd rather not have that fixed basket. I'd rather not have that fixed diversification. I'd rather be able to adjust based on the risk measures that I'm using.
Correct. Right. So basically, I've defined criteria that creates a really great trading environment for me. And amongst that criteria, the markets can either fall into a core basket or they fall into a satellite basket. The core basket are the most efficient markets to be traded for my process at that point in time. And then the satellite baskets also provide really great signals, but for whatever reason, they become the least efficient. And markets can move up into the core basket or they can move down into the satellite basket based on the performance that they have, and also based on a number of other criteria that I use. And because I'm rating the signals as well. So if I'm consistently getting signals that are weak, and then those weak signals deliver losses to me, then that market would fall into the satellite basket. I would still take those trades. And if that market continued to perform poorly, then it would just drop out and just be monitored until the performance changed, at which I wouldn't take trades, but I would measure results based on signals, and then that market could be promoted again. But this isn't something that happens over a short period of time. So, you know, this would happen over a period of years.
Okay, so the adaptive aspect of what you do, you know, your system can deal with whatever market condition on this broad basket of markets, high or low volatility. Why don't you philosophically and operationally discuss volatility? I can still remember for the first time that I even heard the word. It's not a word that the average person could be, you know, a very successful doctor with a nice account. But volatility is not the typical phrase. When people start thinking about making money, they don't immediately say, oh yeah, let's discuss volatility. And that's not what's on the tip of people's tongues. And like I said, even very successful traders don't necessarily fixate on how important volatility is and how important it might be to find a measure of volatility that's robust, stable enough, and accurate enough that you can actually use in real world trading.
Yeah, it sort of came to it, you know, over a period of time. right? And so just to sort of bring it back up again, we talked about, I really subscribe to average true range as a volatility measure. And I use this just about for everything. But primarily I use it to calculate my position size for any of the underlying. And the reason why I like average true range so much is because it's entirely based on price. It's entirely based on price. You can't argue with how a certain market has been performing over a period of time. My average true range I use, generally it goes maybe from 12 to 20 days, somewhere in there. I'm sort of fluctuating amongst that, and it just depends on the different markets. And it's a process that you have to go through with a lot of back testing and trial and error. But let's just say like 15 days, that 15-day average is what I'm using and measuring. To make it simple for the conversation. And you can't argue with this. So when a market performs in a way that sort of violates that level, and it violates that level consistently, then you have to make an adjustment, or you have to not trade that market, for a while, depending on how you manage your system. And so the volatility as that measure gives you basically, I think, the best indication of how a market is performing, and basically gives you a really great indication of when that market is starting to change its bias, from up to down, or if it starts to move sideways. The ATR for a sideways moving market isn't the same as one that's trending. And so that change, if you're looking for that change, when you start to measure those changes over a period of time, that helps you identify reversals, retracements, things of that nature. And then from that, you can develop a pretty decent approach, and you can apply. That's when you decide, okay, this thing's been consolidating for, 30 days. And if it continues to behave like this, probably a good market for me to use options, instead of futures, because I'm not going to get that movement that I need to generate a value. And so that's where the discretion comes into the process.
So you say you can't argue with ATR, but you're a system developer, you're a coder, you like to think through the logic. I think ATR was first put in print in a book, in Wells Wilder's book, in the either early 80s or late 70s. New Concepts in Technical Trading, I believe it was called. However, I seriously doubt that was the first time the ATR concept was used. I wouldn't be surprised back in the early 70s, guys like Sakota and Dung were first approaching and dealing with it. But however, as a guy like, you've taken and evolved a lot of these quant approaches that have been in the worlds that you and I occupy, and you've moved it to where you see things in your research. But then here you come out and you're very open about it, that you are, basically talking about a 3-week ATR measure. And I can see people in the audience that know what an ATR is, and they're saying, why can't you improve that? Why can't you do better than that? Why has it not evolved? Why is there not something new? But it just keeps working, huh?
That's it. I mean, I'm trading to make a return, right? That's it. I'm not trading to be an economist, and I really don't care why it works. I just care that it works, and I don't want to be too trite when I say it like this, but the idea is to find out what is functioning. And the testing will bear it out. You could run a market and you could say, okay, let's try 20 ATR. And, you sort of base your analysis on that, and then you run a back test on it. And then then you run the same test, same, criteria and variables using 15 ATR, and you may end up with better results. And if that consistently happens over a period of time, the question is not the why. The question is just, that it's happening, and that you're pretty comfortable, with the result and taking exposure to that.
Okay, but even getting beyond the parameter, the 15 or 21, I'm sure there's some enterprising young trend following trader, 22, 24, 26 years of age, sitting back and saying, these guys are talking about ATR. This is an old concept. I could do better than ATR. But, in the search for trying to find something better, they might, and you've just correctly pointed this out about your objectives to make money, they might get lost in trying to find this nice, pretty model when the reality is they need a useful model for making money.
Exactly. Yep. Exactly. And there's different levels. I mean, there's different types of risk out there, as you and I know. So the hardest thing is really sort of identifying the opportunity and determining how much exposure to take to that. And then once you do that, the biggest challenge I have today is really not finding the signal. The biggest challenge is execution. So that's where I have a ton of issues, and so that's where sort of the experience bears in.
Okay, but you're talking about, though, for size. So I mean, for the average retail guy that's doing his own account, not as much an issue. However, for those fund managers that are listening, and you're saying, "Oh, size is a problem for me today," I guess that's going to catch their ear.
Yeah, that's the main challenge, and the big issue that I have is basically trying to find the volume, and that's something that I pay particular attention to. I really have to find where people are trading, what the depth of that market is, so that I can really make a reasonable approach. And so when you're entering the markets and exiting the markets, it creates probably that's my greatest area of challenge and frustration. And I execute just about every way possible. So the depth and the breadth of the market has changed quite a bit. There's a lot of liquidity out of it. And I know that Lewis wrote a book and he said the markets are rigged. That's really not the case. For the typical investor, just investing from home, the way they defeat the process is they just basically place limit orders, right? Because they're not sitting behind the chair, they're sitting behind the screen all day, like I am. They're basically probably coming in from whatever they do throughout the day. They're looking at a market, they want to get in and they want to place a trade, so they just put in a limit order, and that sort of defeats any sort of advantage that some of these high frequency guys may have if they do have one.
Yeah, it's amazing. You hear that they come out with the headline that the markets are rigged right at the point in time. And I love Michael Lewis's work, but right in the point in time when he wants to discuss high frequency trading, and I kind of scratch my head and I say, well, shit. If the markets are rigged because of high frequency trading, then what do we describe the Fed's actions at the last 5 years? Does that get jumped up to the word rigging too? And then ultimately, if we all want to have an argument about who's rigging what and who's rigging this and who's rigging that, if we get back to the level of practicality that you've gone at, well, hold on, guys. Even if the market's rigged, there's still a price being traded every damn day. And can we make money from that price? Period. Right?
Right. Yeah, it's he's selling books, so it's great for him. That's his trade, right? So, what's his trade? Book. He's in the book trade, and that's good. That's good for him.
Well, yeah. But the thing is I'm sure he's doing, and I have not read it yet. I'm sure it's a good approach. I like what he does. I think just the headline, though, that, high frequency trading has got I've actually heard from people. They email me now. I'm not trading anymore. I just heard on 60 Minutes the markets are rigged. So it's, you're like, well, hold on. If the high frequency trading's got the markets rigged, well, what about the Fed? So it's,
right.
But it brings it back to what can you do in your life with the opportunities that you see, regardless of what you might hear about rigging or not rigging. And I think that brings us back to the core of our conversation today.
But I guess, just to say it, trading is a competitive exercise. Probably, that's what you have to realize. And most people don't approach it that way. So, sometimes you have to fade the market. So if you have a certain price you want to get to, well, then maybe you have to pretend like you don't want that price.
Okay, now hold on. Clarify that you're talking at moving a decent amount of position when you're talking about this type of strategy.
Yeah. Basically, let's say you want to get in at 190 and the market's not trading 190. The market might be showing you 188, but you need to get in at 190 for whatever reason. right? So then if you are working a ticket, you might work that ticket at 195 or 196. And then when you see that bid trade up into like 190, 191, right? Then you can drop your trade into 190 and get your fill. So this isn't, we're in a competitive environment.
That's more execution strategy, yeah?
That's just a straight execution strategy, but this is how you get your price. It's not always just placing your order to get in. It depends on when you want to get in, the market, or how you need to get in. But to be like quite honest, it's I don't get in the market all the time.
Okay, so you're again going after the guys that want to use high frequency trading as an excuse. You're saying, hey, hold on, it's always been competitive, and if you can't cut the mustard, get the hell out of the kitchen.
Exactly. I mean, that's it. This is the game, right? This is it, right? So I don't get every trade that I want. That never happens, right? That's why I sort of had to I had to evolve myself and create a mechanism that would deliver me signals that met my criteria, as opposed to me making discretionary decisions because I felt I needed to be in the market.
Okay, you're being a perfectionist, though, as you say that. Though, so you don't get every trade you want, okay, but you are going to get filled. You just might not get the trade. You might not get the level you want, but you're being a perfectionist as you say that. Yes.
Yeah. That's true. I mean, I'm being a bit of a perfectionist, but sometimes I miss a trade, and when you miss a trade, it may take you several sessions to get it back. Right? To get back to that point.
No, and as you say that, though, you're talking about some of your strategies that are much shorter time horizon.
Yeah, sure. Yeah, exactly.
Hey, it was good chatting, and we will talk again in the future, sir. Just a quick note at the end there. Something technical went wrong. So Bill and I lost a few minutes on the very tail end of that conversation. That's why it sounded a little abrupt as we close down. I'll try to make sure it doesn't happen in the future. All apologies to Bill. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.